Welcome everybody to our Friday afternoon review of the markets. It's the fifth Friday we've been doing this. It's April 17th. Wayne's had a long, hard day, so I'm not going to be too hard on him today. But I thought we'd start off where we ended. And last Thursday, because it was Easter last week, we talked about the markets having gone through the panic stage, which took us from 3,300 on the S&P 500 to 2,300. And usually there's a bounce of 50% retrenchment. So that'd be 500 points. That would take us to 2,800, which was almost exactly where we were last Thursday when the market closed. And so what happened, David, this week?
Well, here again, it's just the Federal Reserve has been so aggressive. They have just pounded down corporate spreads, been buying corporate bonds, municipal bonds. Any risk of any kind, they will buy it, and they're just not going away. And they want to get on things, very fast. They did learn from 2008. They want to get on any dislocation as quick as they can, and they've been doing that. And so, the story this week here is: do you want to fight the Fed? So really, how tough do you think you are? You want to fight the Fed? You want to short this market? And so that's been sort of put a positive tone to the market, I would say, from that regard. Last night, there was some good news from Gilead in terms of some of their drugs having an impact on those that have the virus. And just more and more visibility on us kind of coming out of the shutdown and going back to work, I'd say. We have some visibility on that, but it's nothing concrete. But those sort of three things are there. But it's been, as you say, it's been a nice retracement.
Right. And, we call this the plumbing, the fixed income side of the market, 7 times as big as the stock market. So it's like an iceberg. You really talk about the stock market, but it's all about the bond market, really. And I just thought I'd make sure people know that Canada did not participate in quantitative easing in 2008, but we are now. We've announced this week $50 billion of buying back of corporate bonds. So we're doing the same thing the Fed's doing. And I talked about it last week, the Humpty Dumpty theory. Once Humpty Dumpty falls off the wall, you can't get him back up. They learned from Lehman Brothers. They don't want Humpty Dumpty to fall off the wall. So that's what this is all about. But we had a great question from one of our clients. We grew up with mom and dad telling us there was no money tree out back, but it feels like there's a money tree out back, and the governments are everywhere. And best guess I've seen from Cornerstone is they think that the extra debt on the Federal Reserve balance sheet will take their debt from 29% of GDP to 38% of GDP, which is about $4 trillion, big numbers. So Wayne, this client, and it's a great question, wants to know what's the implication of that short term? Well, short term, it might be no Humpty Dumpty falling, but longer term, what's the implication of all this debt?
Well, short term, they want to save the economy. Obviously, they're very scared. They want to save it. They're doing everything they can to save it. Longer term, it has implications for inflation. We've been in a 40-year disinflationary period, and I think we're going to go through a change to a new regime. I'm not sure what's going to happen. There could be all kinds of political consequences to this reliance on big government. There's still, there's still income inequality. But I would say it has implications for inflation. The thing to watch there really is gold. And gold has really got a bit of a bid the past month or two. We think it's going to probably break out here ultimately, because they're just going to keep pumping liquidity and money as we go through the next couple of quarters, because we're going to see all the pain come out now. We've seen the panic and all the financial rescue. Now we get the pain, and I think we'll get more money pumped out there, and gold will lead the way, and probably a weaker dollar. So I can't see how they can raise interest rates going with all the debt that's out there right now, going over the longer term.
Right.
So it means
long interest rates and eventually inflation.
And some kind of inflation, and which is usually not really good for debt.
So I was just reviewing our quarterly reports that will be out any moment, and on the first page, Justin, our in-house economist, wrote the conclusion to his page, which I just think is brilliant. We anticipate the pandemic to accelerate the global transition to a digital economy. Like, we were going here anyways, and the virus is a catalyst to speed us up. And to my mind, Wayne, there are 2 industries that are very ripe for disruption and haven't been restructured yet, and that would be the post-secondary education. Universities still are pretty much old school, and the healthcare industry. And this is really going to
Yes.
accelerate their disruption. And, you know, you can learn online and your doctor can telephone you. We now know that for sure. And that's going to take major costs out of those two industries, and major unemployment created in those industries as a result too. But how is the Genus portfolio positioned to take advantage of that kind of disruption then?
We're there. You know, we made a big rotation from a sector perspective in Q1, and we're overweight technology 5%. We're overweight healthcare, and you know, we think those two areas are going to do well going forward. And even some of the other smaller, the old bricks and mortar are getting hit here. Obviously, companies like a good example would be Best Buy. They just laid off 50,000 people, but they're doing well on their e-business, and it's growing rapidly, and they're looking at home installation. So they're restructuring their business right now to survive, and they probably will do well, but they're not coming back to the company they were in the past.
Right. So another question we've got that's a good question, and we often get in bad times, is how's Genus doing? And I think they mean how's our business doing, but I think there was another question that's sort of like how are we doing emotionally? But I think there's two questions there. The first one is, how's our business doing? And because clients worry if we're not doing well, then it's distracting for us. And so what would you say?
You know, our business, you know, our balance sheet is pretty good. Our revenues are tied to the market, you know, what our clients have in their portfolios. And so we took a bit of a hit in Q1. Our margins are wide enough to not really impact us. We haven't laid anybody off. We don't intend to at this point in time. And we're going to actually save money on travel, which is a good thing, because we'll do more Zoom meetings. My life is Zoom meetings now. So we're saving money here, there, and everywhere with the office shutdown right now. So it's our margins are still pretty good. So it's we're lucky to be in this business. We're in the information business. We're very lucky and blessed to be in this business. All I can say. And I think the staff is holding up quite well from what I've seen so far. Everybody's connected. We have daily meetings on Zoom. I'm plugged in with the investment team all day on Hangout and on Slack. And we're actually having our 31st anniversary party on Zoom come this Friday, Leslie, I think.
Yes.
Yeah.
Bring your own.
So we're hanging in there. Every day is kind of like Groundhog Day, though. It's like I have to get out of the house one of these days. But anyways, it's.
Well, one thing I say in these, I think of my father-in-law, and the best father-in-law in the world in 2008. He said this was the best thing you could tell anybody in a downturn, and that is, imagine one morning you wake up and Genus has gone bankrupt, which we won't do, but let's pretend Royal Bank, where your assets are, have gone bankrupt overnight. Well, you are 100% safe. I mean, the world would be a crazy place if Royal Bank's gone broke, but the point is your assets are basically in a safety deposit box at Royal Trust, RBC. They can't be, the word is hypothecated into their business. So if something were to happen, it's not like you have a GIC there or an account or the brokerage house there where it's insured, it's not in trust. So my father-in-law always thought that was a great attribute of Genus, so I thought I'd pass it on.
The money is safe, yeah.
And also in terms of how are we doing, I think all the people who interface with the clients are doing great. We've got a really veteran group. Even the young people are experienced. And I feel most sorry for Mary Lou, who can't cuddle her first newborn grandchild, but she's holding up too. So Wayne, just back to some of these questions. I have, this may be a really silly question, but our municipal governments are getting hammered and are going to get hammered through this process. How does the Genus portfolio interface with that issue, or is it connected at all?
I would say some of our clients might be impacted through a mortgage fund, I would say. But really, I would expect, you're seeing it in the US right now, that the US is coming in and starting to bail out their municipalities. They have to. It works all the way down the chain. All the governments get impacted. In West Vancouver here, I was quite surprised. Our taxes are being raised by 2%, which is not that bad. So there'll be more taxes, I think, for homeowners. And they're going to have, and they also laid off 585 people or something like that. So there's going to be issues there longer term. But I think you're going to see a change in how cities run in terms of focusing more on essential services and less on political issues, which they often get involved in. So it's going to cut us back, but it really hasn't impacted our portfolios, I would say, so far. And we don't have much exposure.
So it's been a pretty good week. No real bad news. We've got to do a lot of time here. I see this as a week where we've done time. It may be a little bit of the quiet before the storm in terms of a lot of horrible economic numbers coming out, like unemployment in the US at 15% almost immediately. Some GDP in China for the first quarter, -6%. So some really bad economic numbers, which the market doesn't seem to care about. It's seeing right through these numbers, wouldn't you say?
Yeah,
so,
it's moving on right now. It's looking through the upturn, especially the technology side. It really, the new digital economy is definitely winning here. It's moved through NASDAQ, for example, is back to where it was at the beginning of the year. And so it's been a big winner. A lot of the companies are big winners in this space because of the move towards the digital economy. And they're looking through the valley too.
Clients should know that we talked about this briefly last time, that when the market went down a lot, we rebalanced and we bought stocks late March. And we've had the bounce, 50% move back. We sold a little bit last week to take us back to our benchmark. So we hope the market keeps going from here. We certainly don't hope it goes down, but if it does go down a lot, we'll rebalance. And if it goes up a lot, we'll probably rebalance. So that's the way we manage the portfolios through this volatility, although it has not been volatile really this week. So I'm going to wrap it up there. Wayne, unless there's something you want to, is there anything I missed?
No, we come in every day. We're focusing on what's happening. We don't know what we don't know. So our moves are very tactical and we have horizons shorter. So we have to be on top of things and we will be.
So I just wanted to say a special, special acknowledgement of our elderly clients who are really locked up and receiving their meals at their doors, sometimes getting out a little bit. We know it's really, really tough, and we have clients like that, and we're thinking of you, and we want you to keep your chin up and know that this will end, and your grandchildren want to hug you as much as you want to hug them. So, so we're thinking of you, and we'll talk to you next Friday. Thank you very much.
Thank you.